Hey, so welcome to Ethereum Classic Community Call number 19. Today is the 29th of March 2022. The time is this week at 1400 UTC, which is a change from normal. And keep an ear out for future updates on time changes. We're trying to figure out the best time to get everyone involved. So there might be some adjustments in the coming weeks, but we'll try and nail something down in future. This week is once again a pretty open and non-guest agenda. We will be opening the floor to anyone that wants to talk. And this is being live streamed to YouTube, so please behave. And we don't want to get kicked off of any platforms. So if you're in the chat, be on your best behavior. And also, if you would like to contribute to anything, feel free to jump in. And as mentioned, this is an open agenda, so post your questions, comments in the Discord or the YouTube. We'll be keeping an eye out for those. Before we start the main topic of today, I believe Henry had an update to loop back into a previous call regarding the hybrid proof of work approach. So Henry, did you want to explain?
Sure. I think so. I presented a structure for discussion around a hybrid proof of work, which was a 50-50 split between SHA-3, Kachek, and GPU mining. The proposal would have kept the ecosystem in check and protected mining from the new ASICs coming on, as well as the existing network of GPUs. During the discussion, the feedback from the community was that it would be hard to implement, although it was a good compromise. And I think that on call 14, we discussed that Epic would withdraw the proposal. So I just wanted to memorialize in the action items on call 13 that the discussion, although productive, was withdrawn.
Okay, thanks for that. And I would my perspective on this is that even if like a particular ECIP is withdrawn, it doesn't mean that the idea itself should be abandoned at all. It's just one implementation potentially of many. And as I've mentioned previously, I think ETC needs to be open to all kinds of proposals, including SHA-3, and how that's done can be in many different ways. So I guess thank you for putting it forward. And even though it's withdrawn, I think it could return in some other format in the future.
Great. Well, appreciate the community working with me. The whole intent of that discussion was to, show a proposal as well as show the potential impact on ETC. So I think it served the second purpose. The first purpose, we'll just keep it open and see, if it could be potential implementation in the future.
Cool. And I don't want to go too deep into the SHA-3 rabbit hole again, but it seems like at least on the Ethereum mainnet side, things are moving forward with the merge. And given that coordinating a SHA-3 fork before the merge seems fairly unlikely at this stage, and with all this sort of narrative of miners moving to Classic, it seems a more sort of long-term implementation approach would be the next stage for SHA-3.
Agreed.
And I guess on that note, we are sitting fairly pretty in ETC land at the moment. I guess since the start of this series of calls, which I think was at the start of December last year, we are now at an all-time high. We very rarely discuss price, but I guess it's a little bit special right now because ETC has broken $50 and is currently sitting above that. And I believe this may be related to a flurry of articles that have come out recently in the last week since we had the last call. 3 articles in particular that we're going to highlight. The first that came out was a post by Bloomberg, which is a fairly reputable and well-known outlet. Whether it's trustworthy or not, who knows? There are, many sides to the discussion, but the exposure itself, I think, has helped the price action that we've seen this week. And that article talks about basically the whole narrative of why ETC might be pumping right now, and that we've discussed on many calls before and kind of predicted. They did, in this article, which is linked in the show notes, get one thing wrong, though, I believe. Brother, could you remind us of that?
Yes, they state that Ethereum Classic forked away in 2016. So that's not true. Ethereum forked away.
Right, this is a common misconception about Ethereum Classic that seems to not go away. But hopefully as time goes by, more people will do their research and figure it out. It's just a shame that a prestigious newspaper such as Bloomberg were unable to figure out that side of the story. But in any case, it's been doing the rounds, and I think overall it's a fairly good, informative article. The next was an announcement from Binance, which they have introduced a mining pool for Ethereum Classic, which previously they did not have. I believe it was just for Ethereum on Ethash, but Binance now have a ETC hash specific mining pool, which is quite big news because Binance is a pretty one of the most well-known exchanges, obviously, and them supporting Ethereum Classic officially in a mining pool just adds some additional sort of clout and respectability to the chain. So we tip our hats to the guys in the Binance pool office. Now, I'm not a miner, so I'm not sure exactly whether this makes any difference in terms of helping miners migrate, or I guess it's at least a more trustworthy source to point your rigs at. But if there's any miners in the room that might want to add anything to the announcement, how this affects Ethereum Classic, please go ahead. Or anyone with any thoughts at all.
I don't think it makes a big difference, but it's always nice to have more choices. And also something good to see on the pool front is that Ethermine, the share of Ethermine is decreasing. It has now fallen below 40%. So that's also a healthy development, that we don't have one dominant pool where everybody hangs out and where bad things could happen if that pool gets hacked or something like this.
On just to riff on that, because a lot of people will point to centralization of mining pools and say, "Oh, this is proof that the chain is centralized," and it's almost used as a yardstick to measure how decentralized a project is. But obviously, it's only one metric, and it could even be a metric that's not really that important, because is it not true that if a mining pool misbehaves, they might be able to pull off a 51% attack for a few seconds, but then the miners will just switch to a different pool. So the centralization of pools, how big of a problem actually is it?
I think miners react so fast, so they could enjoy their 51% for a while. I guess if they just keep paying their miners, they could keep this for maybe long enough for actually do something nasty with it. And Well, somebody could also wouldn't really expect a pool operator to go evil, but there's a certain risk that that a pool could get hacked, or maybe some disgruntled employee does an insider attack, and then the pool's hash rate could be used for nasty things. Of course, if you want to do those double spend attacks, then you need to create your chain in secret for a while. So that would draw some attention. So I'm not quite sure how far you could get with this. Would also depend on how much internal monitoring they have. But fundamentally, it's something that could be used for bad things. So it's good if we don't have any such dominance. And I mean, if Ethermine would fall to something like 30%, then we would essentially have a situation in which even taking control of the two biggest pools wouldn't. Well, you would need at least control of the two biggest pools to be able to do something. So that would definitely be reassuring.
I would posit that also it might be a bit of a misnomer to use the pools themselves as the measurement, because we don't know. I mean, it could be that the two biggest pools are owned by the same person, or a bunch of the smaller pools are owned by the same person, ultimately controlled by the same people, and or the software that's being running on those pools is hackable by the same people. So I think pointing out the relative size, the publicly stated size of the pools, or whoever controls those pools, may be a bit misleading in terms of figuring out how decentralized the network actually is.
Yes, that could be. I'm not sure what the ownership situation behind all those pools is, but I mean, as a first order approximation, when you see a pool that has say 49%, then you already know that something is amiss. You don't even need to look at who owns what. But yes, there could also be. I mean, especially if there was an aggressive policy towards keeping pools down, then this could lead to action where pools just diversify into apparently independent pools, but in the end they're the same hands. So that could happen. But I guess if in the current situation, I wouldn't really expect to have such hidden conglomerates that own a lot of pools. But I mean, I guess such things would also eventually be discovered, and then we could see if there's anything that needs to be done or so. But for now, I would mainly look at the pools and expect them not to be overly connected to each other. I mean, there's also the risk that they might be using the same software for some things, which could have a common vulnerability. So there are always these kinds of risks too.
Yeah, I think the software thing is a sort of overlooked potential problem, especially with some kind of sophisticated supply chain attack, whereby you could be secretly mining a small percentage of hash rate, surreptitiously stealing from everyone that's using your software, basically. And it seems like it'd be pretty difficult to detect.
Yes, you could also have supply chain attacks on the miners themselves. If there's one piece of software that's extremely common and used by a majority of miners, and all these kinds of things. But again, in general, it helps just to keep a diverse environment. This makes it much harder to do those kind of those attacks on where something has naturally aggregated. And well, we can just look for the obvious signs. If something goes in a bad direction, that should already help to identify most realistic attack vectors. And yeah, perhaps the most centralized part we have are the clients. So if somebody could attack on that path, that would be bad. And besides that, it's simply dominant organizations, I guess.
Yeah, we've seen a lot of very high-profile supply chain attacks in other contexts in recent years, so I would not be surprised to see something similar in the blockchain space, and especially for relatively fewer sort of developer projects like Ethereum Classic is something to look out for.
I just want to add related to the Binance pool that they also offer a price, $10,000 price. So for any miners out there who are interested in this, they should check the article.
Is there any reason in terms of profit motive that a miner would not use Binance? Like, what goes through the miner's head when they're deciding which pool to use?
I guess most of them will probably just look for any information on what is a pool where I can mine X. So they would probably look around on ethereumclassic.org. They might be looking at mining pool stats, which pools are there, and then they might go based on what other people say. If they're a bit more sophisticated, then they might find pool profitability comparisons and look at what they see there, or maybe they just look around on fora where people discuss pools sometimes. I mean, what a miner is typically looking for is a pool that that pays regularly. I mean, especially for smaller miners, they want to see money flowing on a relatively regular basis, even if it's not a lot. And so they will tend to prefer larger pools because they find blocks more often than small pools. And they will also have considerations like ease of use, maybe geographical distribution. That's already a bit more sophisticated. They will definitely be interested in pools that are not that don't cause them problems, even if the problem comes from the miner and not from the pool. That's particularly true for unsophisticated miners who might have an incorrect configuration of the hardware. Maybe they're overclocking too aggressively, and then the miners is producing lots of bad results. And if a pool accepts it anyway, then they're happy. And if a pool rejects those things or even bans them because they're sending too much garbage, then they hate it. So you get these things. And so yeah, that's basically there's a big bunch of considerations, and then you've also things like the pool fees and the payment scheme, whether you get anything from MEV, which is not a big thing on ETC, but it's more important on Ethereum. But when ETC picks up more traffic, then we will also see MEV become something that's relevant. So it's a lot of little things.
Just for the listeners, MEV is miner extracted value, right? Could you explain what that is?
That's basically when you can realize additional gains by organizing the transactions in a block. So you can. I'm not actually not entirely sure how this is paid for, but I think that there may be some that you may be able to basically bribe the pool to put your transactions in a certain order, which then lets you, for instance, get a better position in an auction, or maybe you can sandwich a transaction that will change the coin value such that you benefit from the change, and so on. I haven't really studied this in detail, but this is roughly the kind of things you can do there. So this is basically an added value, because normally you would have the transactions go into blocks basically randomly, and with MAV you create a mechanism where you can control the sequence and produce additional value. And then there's a bit of a debate whether this is good, whether it's damaging or not damaging, and whether it's ethical or not. So they get this angle too. But basically, it's the protocol allows it. So if we take a strict code is law stance, then that's fine.
Right, it's kind of it's left up to the client side to figure out which transactions to put in. There was, I believe, a proposal from Biro a few weeks ago that was attempting to try and fix this by adding some kind of enforced randomness into the ordering of transactions, but I'm not sure. It's a pretty complicated area, and whether it's a problem and B, one that needs to be fixed, and also can be fixed by randomness, remains to be seen, I think. But it's definitely an interesting thing. I believe in terms of the bribing system on Ethereum mainnet, there are even DAOs now that have tokens that you can just buy and use to directly in your contract bribe miners, so they can be aware of a specific like prepayment, if you like. It's like a topped up SIM card that you can use in the form of tokens to ensure that your transaction gets through because you have these tokens as part of your transaction. And yeah, another one of the things that could be and probably should be ported to Ethereum Classic, not if but when it becomes the largest smart contract chain. Was there anything you wanted to...
I just
Sorry, go.
provide explanation of NAV in the community call notes.
Oh, cool. Yeah, I'll add that to the agenda.
I guess the other consideration for considering the pools would be, what's the pool fee, and then the convenience of going, intra exchange at Binance between the different coins. Just simplifies your transactions and liquidity when you're working with one exchange. That said, I'm working with one other pool to add ETC. So, they just recently moved to Ethereum. So we're in discussions of porting support for ETC.
Right. All of the like Ethereum mainnet pools in theory should be like lining up to support ETC at this point.
Correct. That's what I think too.
Do you think it would be possible even to somehow have the pools automatically switch their existing miner base onto ETC? in some way?
Yeah,
Or
so
like,
there is. Sorry, I didn't mean to interrupt. Finish your comment.
no, that was it basically.
Yeah, so there is the ability to auto switch. Some of the I haven't seen it implemented, but certainly on SHA 256, people were doing profit switching between Bitcoin Cash, the various flavors, and Bitcoin itself. So it's quite possible. I'm going to talk to my contact to see if that's something they want to implement. The obvious trade-off will be, the perceived return on investment, given that ETH, may merge. It's just their perception of when ETH merges.
Right. But I guess in a lot of cases, well, some miners just might leave their stuff on and forget about it. And if they're just mining a dead chain, then they might as well switch to something that's at least potentially profitable.
Some automatic switching would require a new kind of also a miner side support on the protocol level, because they need to use a different DAG than they use for Ethereum. So, and then just the normal protocols you used to talk to a pool, they don't provide this information, which incidentally is also something that helps to protect us from things like hash rate being brokered through things like NiceHash, and which was basically one of the enabling parts for the 51% attacks in when was it, 2020, and so that's not necessarily a bad thing that this isn't possible. And but so if you have a normal pool and your miners don't have any special extensions for switching algorithms, even if they are similar, these algorithms, then you cannot just give them Ethereum classic blocks to mine. They need to change on their side, or if you have such a protocol extension, then this protocol extension would have to tell the miners to switch to this different kind of DAG. That, I mean, we have at the moment we have 3 different types of DAGs in the ETH space. We have the ETH DAG, we have the Ethereum Classic DAG, and we have the Ubik DAG. These are all those 3 groups. It's two individual coins which have their own variant of ETH, and then there's a cluster of coins with Ethereum and many small ones like Callisto, Expanse, Metaverse, and so on, who are also using ETH, but they're much smaller than Ethereum Classic, and also much smaller than Ethereum. So in any case, so for each of those switches, the mining software needs to know which that it needs to generate a different DAG, and then use this for the actual mining loop. And this information has to come from somewhere. And at the moment, I think I don't know of any poolside protocol that would tell the miner that it should switch to a different type of DAG. Of course, miners
Where do miners
can change
typically? Sorry, how do miners normally sync with a DAG? Like, where do they get this DAG from normally?
They calculate it. The mining software knows the algorithm that defines how to generate the DAG. Then when they connect to the pool tells them typically it gives them the seed hash, but it could also tell them the block height. It's essentially the same information, and then the miner can can generate the DAG that's needed for the current epoch, and then it will then the pool sends them a header hash for the block that it wants to mine, and then the miner runs the algorithm with this header hash and with a series of nonces using that DAG that it has generated for this seed hash. When the block changes, when the next block comes, then the pool will send another header hash for this new block, and the miner will stop the mining of the old header hash and start mining with the new header hash, and also probably reset its nonce counter. And when the epoch changes, then the pool will send a new seed hash, and then the miner will either generate or retrieve from a cache, because DAGs can be pre-computed. So it will use it will load a new DAG into the hardware, and then the same procedure repeats. And this goes on forever like this. And
Also,
nowhere in there is an indication what kind of algorithm you use.
I'm just wondering if there's anything that mining pools can do to make the life of refugees easier.
Provide them with well, first of all, implement etc if they haven't done yet, and provide them with instructions. It's not difficult. I mean, for most miners, it's basically one click to switch over to etc, and then they need to change the URL for the pool, and then they're on their merry way to mining etc.
I think it's also worth mentioning the gap between Ethereum and Ethereum Classic in terms of profitability. I'm looking now at flexpool.io, and we can see that the estimated earnings for daily mining. So Ethereum has $5.57, and Ethereum Classic has $3.64.
Yeah, the relative mining profitability goes up and down quite a lot. It has been, I mean, first of all, it depends on how much you pay for energy and other operational costs. So it has been until mid-March. It has been, well, at the beginning of the year, it was at around 55%. So for every hash, you would get for every hash that you were mining on etc, you would get 55% of the value of basically this an equivalent hash that you were mining on Ethereum. And it started at the beginning of the year around 55%, and then it slowly crept up to something like 62% till mid-March, and then the big value increase of etc happened, and it jumped up to 80%, even got very close to 90%, or maybe even went over it, and stayed there for a few days. And now it has started to drop again, and now it's around in my statistics, which are a bit delayed because I'm using some 24-hour smoothing and so on from what to mine, where you can get all the base data for these calculations. Now it's around 65%. This this is the drop has mainly been driven by Ethereum profitability going up quite substantially in the last couple of days, and it doesn't have the latest increase of Ethereum Classic yet. So I guess it will go up to above 70% soon. And this relative profitability is always very noisy, because it's also affected, for example, by auctions. So whenever there's an auction on Ethereum, we have very few auctions on Ethereum Classic. So whenever there's an auction on Ethereum, people pay extra fees to get their bids quickly to the auction contract. And this means that all of a sudden the mining revenue jumps up quite a lot, because it can, all those fees get distributed, get sent to the miners, and those blocks that are sent to the auctions are very profitable. And then so you see the relative profitability between ETC and Ethereum crash, because Ethereum is now a lot more profitable briefly, and if Ethereum Classic doesn't have the same profitability movement, and then 24 hours later, when this averaging period is over, then it jumps back to the previous value, and you get this, well, every few days, sometimes every few weeks. And so this means that you get like lots of spikes and strange things on those graphs, and you really have to look at those at mining profitability over a longer period of time. I can post my latest graph in a bit.
I would also imagine that a lot of the profitability is undetectable because of MEV, right? Like, we don't actually know how much they're making.
Yeah, I'm not sure how, to what extent you can tell what profits come out of MEV. Not quite sure how the whole system is organized at the moment. But I mean, the traditional sources of profit are the emission, which is the coins that you get automatically when you mine a block, and the other part are the fees, which the miners pay to provide an incentive which the users pay to provide an incentive for including their transactions in a block. And those two things combined, they make up for most of the block reward. And MEV is usually somewhere on the side, so this is something that the pool extracts, and then it can share it with the miners, or some of them supposedly they just keep it for themselves. But these are not the primary miner rewards. And speaking of the profitability, when I look at a setup where you have something like 20 to 25 terahashes per US dollar, so this would be a case where you have an efficient a power efficient miner, and you pay something like a power efficient GPU miner, I should say, and you pay something like 4 cents, 4 US cents of the US dollar per kilowatt hour. Then you would get a profitability for ETC at the moment of about 1000%. So basically, for every dollar you spend for electricity, you get $10, well, $11 on mining rewards. And with Ethereum at the moment, remember that it spiked recently. It's a bit above 1,500% on my statistics, which are a little bit behind the situation at this very moment. Just to give you a number of an idea of the numbers that we have there. So there's a fair margin in there. So this also means that if your mine is not so efficient, or if you pay a lot more for electricity, it's still good. We will have to see what this looks like after the merge and the flood. And although some miners have even better operational costs. So I think the most efficient mining hardware at the moment for Ethereum and Ethereum Classic is the Jazz miner, and this one gets more like 60 terahashes per US dollar. So it's about twice as power efficient. No, sorry, 4 times as power efficient as what I described here. And also some people pay even less than 4 cents for the kilowatt hour. The prices can go down as low as something like 1 cent. Obviously, those don't worry so much about power efficiency anymore. They're more interested in how much a miner costs. So also this changes a bit. But in general, the main differences are now more on the power cost than on mining hardware efficiency. And so yes, this is basically the picture that with Ethereum Classic, if you're in a good setup where you have a low power cost and industrial rates in a country that's not too expensive, then you can make something like 10 times what you pay for electricity on Ethereum Classic, and it's a bit better. It's a bit nicer for you on Ethereum, but also Ethereum Classic is getting closer and closer. I mean, a few days ago, Ethereum Classic was still at 1,000%, and Ethereum was at something like 1,100. So they were very close. Now another gap is a little bit larger, but it's going up and down. So that the general trend is good. That the profits are going up. This is what we want to see.
Thanks for that explanation. And yeah,
just to quantify that, on a return so excluding power, the mining profitability on Ethereum is 5.4 cents per mega hash, and on ETC it's 3.8 cents per mega hash. So the gap is definitely closed. I think it's 70% of the profitability of ETH, compared to about, if I recall correctly, it was about 40% of the profitability. And of course, this excludes power, so that's a hardware agnostic comment.
And I guess the other thing to note here is that the price of ETC in terms of overall liquidity requires a lot less in terms of fluctuation than Ethereum in order to double or triple or 10x. So that profitability has potentially much easier potential to match and overshadow Ethereum's.
In terms of coin price, I'm looking here at a chart, ETC BTC chart, and we can see that in March ETC has moved against BTC like 77% higher.
Yeah, it's definitely feeling like the train is leaving the platform, and yeah, if you haven't boarded yet, now's the time.
There is also the 15ing, so which will occur in about 2 weeks in April. So mid-April we will see the 15ing happen, which basically is reducing the block rewards with 20%. I also want to mention a pull I've made on Twitter, if it's okay.
Yeah, go ahead.
Yeah, so I made a poll on Twitter. The question was, how much time did you manage to hodl ETC? The first answer was 1 month. I'm a noob. It got 5.7%. 6 months. I hate bears. It got 9.8% votes. 1 year, I get the tech. It got 51.8%. 6 years, code is low, 32.6%. So this poll, which got 193 votes, is showing that Ethereum Classic has a strong base layer of investors who are willing to hodl the coin during both trends, both bear and bull trends.
Yeah, I think one pattern that I've noticed looking at those charts is that Ethereum Classic seems to settle down at a level, and it has a very strong sort of base layer, as you mentioned. It never really dipped below much in the last two levels that it was at. I just wanted to mention there was a message in the community called Chat Channel from Werner about the Bloomberg article, and basically saying that I'm going to quote what the article says just so we can straighten out whether or not they were telling the truth here. But I quote, Ethereum Classic got started when some Ethereum miners refused to upgrade their software to reverse a hack that impacted an Ethereum project called the DAO back in 2016. And also, Ethereum Classic, created after a 2016 software change for the most used blockchain, has jumped more than 80% in the past week. So I would say this is a bit grey area. It's not strictly incorrect, but it's also not strictly correct. So Ethereum Classic itself wasn't created. Maybe the name was applied for the first time, but I think it can be misinterpreted both ways, and it would be nice if in future it was properly sort of explained what actually happened, because Ethereum Classic wasn't really created at the DAO fork. It was Ethereum that was created. So yeah, I'll give them the benefit of the doubt here, and I retract my previous statement about Bloomberg lying.
I'm also not so sure if it's if we should really put too much focus on who forked from whom, because it's largely irrelevant by now. I mean, both exist and both have years of their own history, and I guess all the old battles between the two camps, they must have died down largely by now. So I don't really think it adds a lot. I mean, it's more. I think it's more important to emphasize what are the characteristics and what are the values that one has and the other doesn't. And because it also may come across as kind of petty if you always bring up this thing, which doesn't really have, well, it is a historical interest, but it doesn't really have an effect on what's happening today, I would say.
I would push back slightly on that, because I think one of the misconceptions is that Ethereum Classic is just like a kind of throwaway, like a fork of Ethereum that never really got traction, and just some like a handful of guys got together and was like, oh, we can make some money out of this. Basically, it's some kind of scam, right? And there are a lot of other projects that are sharing that characteristic of just being just another fork. But I think the history here is pretty important, and Ethereum Classic being something different to that can, I think, potentially have a lot of value in terms of the narrative. And yeah, I agree with your sentiment that it's not good to sort of be petty about it, but I think at least sort of demystifying that, like debunking that initial belief that it is just another sort of scam project. A fork.
Well, any thoughts of it being a scam project should evaporate as it grows. So that may not be a big issue for much longer if there are actually people who believe it's a scam project. I'm not sure about that either. I mean, it's been around for a while, so, and yes, it hasn't been growing as much as Ethereum did. But that's also part of the history that we have to live with, and can only be eradicated by growth and not really by explaining the historical roots, because it's already a historical fact that Ethereum grew more than Ethereum Classic did, and that Ethereum Classic suffered because of its smallness. But it's now becoming big, so these things will eventually fade away because they're just history, but don't have much to do with the present anymore.
Yeah, that's fair. I suppose the points of history at one point maybe have been a bit more sore than they are now. So yeah, potentially time to let that go. And yeah, it's just surprising. I mean, upon reflection, Ethereum Classic is now valued at like $6.5 billion, which is quite a feat for what would otherwise be considered a scam project. But that it is certainly not. And I guess congrats to everyone, and kudos for contributing and being on the train, because it's been a lot of work and a lot of time and a lot of contributions and effort. So it's finally seemingly yielding some reward.
Yes, if we If we look at the addresses metrics, which I follow from time to time, we can see that addresses with balances that have more than 100K went up to 2044. Addresses with balances that have more than 1 million in ETC also went up to 566, and addresses with balances that have more than 10 millions in ETC are about 84.
Wow. And speaking of whales, that brings us nicely to the final article that was released this week by none other than Grayscale. The company that's owned by some might say the godfather of ETC, Mr. Barry Silbert. And it's nice to see another article from Grayscale giving ETC a bit of attention and love that is definitely deserved. Again, that article is posted in the show notes and you can peruse it at your leisure, but it's basically, I'd say, a more accurate and in-depth, similar to the Bloomberg article, covering the same topics as to ETC's recent price rise. Interestingly, it makes the argument that it points out that the expected increase in hash rate hasn't necessarily happened yet, even though miners will eventually switch in the future. And the price can rise in anticipation for that, but it might not translate immediately into an increase in hash rate because Ethereum Classic is still not as profitable as Ethereum right now. But we can expect that the hash rate will jump very significantly when there's no other options.
The article is also mentioning the fact that with an increased hash rate, ETC becomes more secure, and it may attract a lot of development in the near future.
Yeah, there's some argument about whether or not hash rate follows price or price follows hash rate. And I'm starting to come to the opinion that there's no like causal relationship. I mean, there is a slight causal relationship, obviously, between increased price leading to miners selfishly mining the chain. But in terms of long-term trends, I would suggest that the increase in miners in terms of interest in the chain is potentially what kicks off the increase in price as the causal, like, first thing that happens. So I think it really just depends on what kind of time you're looking at in terms of scale. And in the case of miners moving to ETC, whether that immediately causes a price rise, probably not. It might have a short bump, but I think in the long run, the additional mind share will definitely cause a price rise. This is not financial advice.
I would say that miners generally follow the profit. So if they can choose between multiple coins, and especially if they're closely related, like coins in the ETH family, then they will occasionally look at the profitability, and if they see, oh no, this other coin is not doing much better, or than the one that I'm currently mining, or also if they see that the coin that they're currently mining is planning to do something that they don't like, that will not make the mining will not allow them to mine profitably in the future, like what Ethereum is doing. And the second best is already close, then this can motivate a change. And I guess it depends on there's basically an individual difference between miners how often they consider changing. So miners can also sit in a very unprofitable situation for a long time simply because they cannot be bothered to make even a small change. But that differs from miner to miner. And if you look at the graph I posted in the call notes, and then you go over to 2 miners for the Ethereum classic hash rate, then you look at the 1 year set of the data from 1 year, from this year, sorry, then you will see that the profitability graph, the profitability ratio graph between Ethereum and Ethereum Classic quite closely mimics the Ethereum Classic hash rate. So I would say that this is probably one thing that most of the miners will pay attention to when they're comparing profitability, the relative profitability. So if we get close to matching Ethereum, then miners will come over, and if we have a large gap, then they will go back to Ethereum. And the same thing will happen to a less extent with other coins. I mean, for ASICs, it's potentially all the other Ethash type coins, and for GPUs, it's a few more like Raven and Ergo, and but also the distribution will be determined by the profitability ratio. And the profitability ratio is also if I look at the at ETC's profitability alone, then it also bears some similarity to the ratio. So this has a strong influence on the profitability ratio, and then not so many common elements that would between Ethereum and Ethereum Classic that would offset any changes.
I guess I'm thinking like a post-merge that a lot of miners are just going to be forced to mine a chain like ETC, even if it's not profitable. They'd rather be utilizing their hardware for future potential upside as opposed to just turning it off and having to go to the effort of disassembling their rigs and stuff. And that's probably going to be quite a significant amount of hash rate doing that. And that in turn causes them to have more interest in ETC and contribute in other ways than just hash rate.
Yeah, some miners may decide to to continue mining even if it's not profitable, for at least for some time, in the hope that it will become profitable again, and may also that will retroactively become profitable when the coin value rises. Then they will have mined some ETC that were not profitable at the time, but if the value say doubles, then it will have been profit. It will make the coins that they have mined profitable. So yes, there can be these calculations. Eventually, of course, if mining remains unprofitable for them, for example, because their power costs are too high or general the operational costs are too high, and the value is too low, then eventually they will have to give up because they're not a charity that keeps the energy companies alive. So, but yes, there can be a long transition period where the miners will not stop, even though it's not profitable at the time for them.
Is it possible that some dynamic could arise whereby only the very small, like 1 or 2 rig miners, are incentivized to mine because they care relatively little about the economy of scale of electricity cost, and for them it's more of like the main overhead is just the hardware, and it's more of a hobby thing. So it could potentially decentralize the network more by
That would be the Ubik type of scenario where mining is terribly inefficient. In terms of profitability, but they still maintain the loyal miner base. And yeah, I'm not sure if this makes a big difference. I mean, one big farm can make up for quite a lot of small miners. So I would expect, I mean, a big farm can afford more efficient hardware. So they can be equipping the farm with ASICs. There certainly are farms that are equipped with ASICs that are not on the market. I mean, there's this called Antminer. I think it's Antminer. The A11, which I think hasn't been seen on the market, and all these probably go into self-mining by the manufacturer, and also Lynchy doesn't have, for example, a big enough production to sell to the general public. So there's also a relatively small group of operators which have a larger number of miners. And again, this is one of the more power efficient miners. So you get these concentrations, and then you get all the large farms, the large GPU farms, which may also have bought equipment that is power efficient, and which is of course more expensive too. But it makes sense for them because they're really, I mean, it's their business, so they want to optimize the spending pattern. And of course, all those big operators will tend to tend to operate in places where they get a good price for energy. So yeah, they will not be sitting somewhere in a residential area in Germany where they are paying for their nose for electricity, but they might be sitting somewhere in Siberia or Norway or so, where they get cheap hydropower that costs them less than a tenth of what others are paying. And so basically, the bottom line is that large operators, they have a natural advantage simply by economy of scale, and they are not likely to get pushed out so quickly. So while there can be a significant number of small miners who just keep on mining for the love of it, and even if they're actually losing money, they will not really change this situation. So I think the large operators are much more likely to not have to fold than small ones, already because they will tend to have better energy cost.
Okay, well, we have breached the hour, and as always, we will open up the floor if there's any final questions or comments, and if not, we will wrap things up.
Just one final comment about ETCG. If we have investors or traders looking at the chart, we can see a good push. Just a second.
So ETCG is the Grayscale fund?
Yes. So it had a very long bearish trend, and we saw that after ETC went up very fast, ETCG is also making a bullish trend on the daily, and I'm also expecting at least indicators are showing, like MACD is showing on the weekly a reversal. So ETCG may go very strong, may have a very strong bull trend in the near future. So it's worth checking that out.
Thanks for that. And I fully endorse all Grayscale products. And yeah, just one final call for if anyone would like to join us on a future call, either as a guest or as just a contributor, we would very much welcome your contributions. So please do reach out if you'd like to say something. And on that note, we will wrap things up for this week. Thank you for joining us. Another fruitful conversation. And yeah, see you next week. Probably same time at the same place. Bye-bye.